So, you've probably heard of this thing called the bucket strategy for retirement, right? It's super popular. But here's the big debate. Is it a genius psychological tool, or is it just bad math? Well, today, we're going to unpack all of it. We'll look at how it works, where it came from, and, this is the important part, how you can build a much smarter version that actually works for the modern world. Okay, let's play out a scenario. Imagine this. You've spent 40 years doing everything by the book. You've saved, you've invested, you're finally ready to retire, and then in your very first year of freedom, bam, the market just craters, drops 30%. I mean, that is the absolute nightmare scenario for anyone just starting retirement. And believe it or not, this fear has a name.
Is called sequence of returns risk. And here's the deal. It's not just how much your investments return on average that matters, it's when you get those returns. Think about it. Getting hit with a big loss right at the beginning when you're also starting to pull money out to live on, that can be a knockout blow for your portfolio's future. And this, right here, is the exact problem that the bucket strategy was designed to fix.
All right, so let's dig into this a little deeper. This is what I call retirement's biggest financial fear. This whole nightmare of the double drain.
Just think about what's happening. Your portfolio's value is getting hammered by the market, and at the same time, you're pulling money out just to pay your bills. You're getting hit from both sides. It's a double drain. You're forced to sell your investments when they're at their lowest price, which just guts your portfolio's ability to recover when things turn around. It's this vicious cycle that can and does cause people to run out of money way, way too early.
So, how in the world do you stop this from happening? Well, this is where the simple bucket solution comes in. You can almost think of it as a kind of behavioral insurance for your money. It's designed to protect your portfolio from your own worst enemy, your own panicked instincts.
And we have a guy named Harold Ivinsky to thank for this. He was a financial planner back in 1985, and he noticed his clients were all making the same devastating mistake. Whenever the market took a nosedive, they'd panic and sell their stocks right at the bottom. So his idea was brilliant in its simplicity. He said, let's create a separate, totally safe pool of cash, a reserve that could cover their living expenses. That way, they could just leave their stock investments alone and give them time to recover. You see, it wasn't about complex math, it was about managing human behavior. Okay, so this is what the classic model looks like. It's usually broken into 3 buckets. Bucket number 1 is for the now. We're talking 1 to 3 years of expenses. This is your ultra-safe money, cash, money markets, CDs. Its only job is to not lose value. Then you've got bucket number 2 for the soon. Say the next 3 to 10 years. This is for stability and a little income, so you'll see things like core bonds or tips in here. And finally, bucket number 3 is for later. This is your growth engine. It's packed with stocks, real estate, the stuff you won't need to touch for at least a decade.
Now here's the magic of how this whole thing protects you. You live off the cash in bucket 1, period. If the market has a total meltdown, who cares? You're not touching your stocks. You just keep living off your cash. And if the downturn lasts a couple of years, you can start tapping into the stable bonds in bucket 2. See what's happening? Together, those first 2 buckets can create a buffer of maybe 10 years. That's a decade where you never have to sell your stocks in a down market. It gives them all the time they need to recover.
And a psychological payoff here is just huge. It taps into this thing behavioral economists call mental accounting. You're no longer looking at one giant, terrifying pile of money that's bouncing around every day. Instead, you've got 3 smaller, manageable piles, each with a very specific job. Just knowing that your living expenses for the next couple of years are sitting there safe and sound in cash makes it so much easier to ride out the storm in your stock portfolio without freaking out.
Okay, so this is where we get to the heart of the matter. It's really a showdown between peace of mind and pure math. Because, while financial advisors on the ground absolutely love this strategy for how it helps their clients sleep at night, a lot of the number-crunching academics, well, they say that peace of mind comes at a pretty steep price.
So here are the 2 sides of the coin. The big advantage, the behavioral one, is that it gives you that sleep well at night feeling and stops you from doing something really dumb, like panic selling. But the academic critique is pretty sharp. They say it creates a huge cash drag, that's money sitting in cash not growing, and it can actually stop you from doing something really smart, like rebalancing, which is just a fancy way of saying buy low, sell high.
And we're not talking about small potatoes here. This cash drag can be a really big deal. When you stretch it out over a 30-year retirement, the amount of growth you miss out on by keeping all that cash on the sidelines, well, it can literally be hundreds of thousands of dollars. So yeah, that's potentially a very expensive good night's sleep.
So, if the classic model is flawed, what's the answer? Do we just throw it out? No, we evolve it.
We need to move past this black and white debate and start building a smarter, hybrid approach, one that takes the best from both sides.
One really smart evolution is to combine the bucket idea with something called a guardrail system. The difference here is really important. The bucket strategy changes where your money comes from. You switch from drawing on stocks to drawing on cash. But a guardrail strategy changes how much money you spend. It creates rules that basically force you to tighten your belt a little bit when the market is down.
All right, get ready for this one because it's going to sound completely backwards. We're always told to get more conservative with our money as we get older, right? Well, some fascinating research from guys like Michael Kitzes and Wade Pfau suggest you should do the exact opposite. Their logic is that your biggest risk is right at the start of retirement, so you should actually start out super conservative, maybe only 30% in stocks, and then as you get older and that danger zone passes, you gradually increase your stock exposure. I know, it's wild, but the math is pretty compelling.
Okay, now for the next level of sophistication, we're not just talking about buckets for time, we're talking about buckets for taxes. A really smart plan will have your money spread out across 3 kinds of accounts: your regular taxable brokerage account, a tax-deferred one like a traditional 401k, and a tax-free one like a Roth IRA. Why? Because it gives you incredible flexibility in retirement to control your tax bill from year to year. It's a total game changer.
But we have to ask the tough questions. How does a simple bucket plan hold up under real extreme pressure? I'm not just talking about a stock market crash. The true nightmare scenario is when everything goes wrong at once. Stocks are down, bonds are down, and inflation is through the roof. You know, like what happened during the stagflation of the 1970s. And if you look at the numbers from that so-called lost decade, it's pretty scary. Once you factor in inflation, both stocks and bonds, your bucket 3 and your bucket 2, were losing you money. Your cash in bucket 1 was basically just treading water. The only things that actually made you money were assets that could keep up with inflation, like gold and real estate. And that's a huge lesson. A modern plan has to be ready for more than just stocks going down.
Okay, so let's put all of these pieces together. We can absolutely build a smarter hybrid strategy. And it really boils down to 5 core principles for a truly tough retirement plan.
First up, segment by your actual needs. Don't just use a flat percentage for your cash bucket, size it for your essential spending. Number 2, rebalance both ways. Have a plan to skim profits from your stocks in good times to refill your cash bucket. Call it an upward waterfall. 3, be flexible. Build in those guardrails so your spending can adjust automatically to what the market's doing. 4, asset location. Use those 3 tax buckets, taxable, tax-deferred, and tax-free, to slash your lifetime tax bill. And finally, number 5, prepare for inflation. Make sure you have some assets in your portfolio, like tips or real estate, that can handle a 1970s-style stagflation.
At the end of the day, here's what it all comes down to. The arguments about the math are interesting for sure, but they kind of miss the point. The real power of the bucket strategy is that it's a system designed for people, not for spreadsheets. Its biggest job is to manage the single greatest risk in retirement, which isn't the market. It's you. It's your own behavior, your own fear and panic.
Because look, you can have the most mathematically perfect retirement plan in the world, but it is completely useless if you can't stick to it when things get really scary. So as you think about your own future, you have to ask yourself a very simple question. Is my plan built for a spreadsheet, or is it built for a human being?